So it's that time of the year again, people, where, earnings season has come around and there's going to be quite a lot of, companies that's actually going to be reporting their earnings over the next couple of weeks. Many other banks has already actually reported their earnings. And, normally with earnings season, the beginner investor is keen to actually take advantage of, a possible increase in the price of the actual stock, right? They go out and they buy the stock, or they go and buy a call option to actually take advantage of a perceived increase in the stock's value. And this is one of the biggest mistakes that newer investors actually make. It is one sure way to actually ruin your portfolio, because you actually have no idea how the market is actually going to interpret the information that's going to come out of that earnings call, right? And if you are buying the shares outright, please do so on a dollar cost average basis. And if you are buying call options to take advantage of the price increase, you can get slapped with a massive IV crush at the end of the day. So here are the three major pitfalls specifically around earnings and that beginner traders needs to definitely watch out for. Pitfall number one. Earnings are normally reported after the bell, right? So we normally trade between 9:30 and 4 p.m. Eastern Standard Time, but earnings are normally released after the market has actually closed. So you have no real control with regards to, taking advantage of it or having that information at hand early before you actually put in your trade, right? And if that specific stock jumps 20 or 30%, or even, takes a dive by 20 or 30%, you have absolutely no control over that because you've already placed your bets, right? Pitfall number two, the beat and drop fallacy, right? Beginner investors normally think that, when a company beats earnings, the stock will automatically go up. And that is such a fallacy. In reality, Wall Street trades on forward guidance and secondary metrics, not just the last quarter's headline number, right? And this is really important for beginner investors to understand. When we first started trading, we'd look at, the earnings after market, and we'd see like, oh, the company actually beat their earnings. And we'd come back the next day, look at our actual portfolio and see that the stock is actually tanked by 10% and wonder why, right? And this is why it's so important for beginner traders to actually understand the pitfalls that they can get into specifically when trading around the earnings season for a specific company, right? Okay, pitfall number three is super important specifically for those of us that actually trades options, right? Pitfall three is implied volatility, or IV crush as it's known to option traders. So what actually happens within this mechanism? Because there is quite a lot of volatility and uncertainty in the market, the volatility basically goes up on that specific option chain and it becomes a lot more expensive. And because it's a lot more expensive prior to earnings, you're going to be paying a premium for buying a call option at that specific time. So let's just take an example. You're buying an option call for roughly about $10, right? As soon as earnings is reported, the volatility will come down and the value of that option will literally fall through the floor. And even if the company did have an earnings beat and the stock went up by 2%, you'll sometimes find, or a lot of the times you'll find, that call option that you actually bought is now worth less and you've actually lost money instead of making money. So this pitfall number three is super important to understand specifically for newer investors, and specifically new investors that's buying options just prior to earnings actually being released. Okay, so we've gone through the three pitfalls, right? And that is the risk of trading hour isolation, right? The beat and drop fallacy, number two, and number three, the implied volatility crush. But I don't just want to give you theory, I want to give you actual real world examples of where this has actually happened. So you don't get blindsided by dollar cost averaging around earnings or actually buying a call option around the earnings period. So for that, let's jump into our trading platform. Okay, so I'm going to go through two real world examples today and actually just give you a bit of a feel for what this actually means, right, when you're actually looking at the charts. Right now, we're actually looking at Netflix, and a couple of things that you need to note first. This is earnings, right, where these little red dots are, right? Earnings here, and they've just actually had earnings probably 2 days ago. And what I want to bring your attention to is the price drops or increases at these earnings dates, right? You'll see that there's quite a lot of volatility coming in first and foremostly. But at earnings, you can see that the price has dropped significantly, right? And Netflix has actually had beats in all three earnings. They've had great subscription numbers. The company was doing well. But the market was just not convinced with the direction that they were taking for the next 5 years, right? Same thing happened with earnings prior to the current one that we've just had. And you can see the massive drop that Netflix has actually had on the day, right? We are talking about a $10 drop in actual stock price just on earnings. And then again, Netflix has had earnings recently. And again, we had another massive price drop because this is forward looking, right? This is not actually what the company is doing right now, today, right? And what the earnings is for this specific period. It's more a forward-looking guidance on where Netflix is possibly going to go. Now, again, Netflix is looking at a lot of investment into the sports arena, and investors are not yet convinced that this is actually going to pay off from an investment perspective. Okay, so there's another company that I actually want to use an example, and this is Google. Google's actually having earnings in a day, which is tomorrow. And I want to, again, bring your attention to the earnings, right? The little red bubbles on the screen. And you can see the massive drop that actually happens on earnings, or the massive increase that actually happens on earnings, right? Now, why have I chosen Google today? Google's got earnings coming out tomorrow. And I actually want to show you what implied volatility looks like, specifically if you are an option trader, right? So with that, I'm going to jump into the option chain for Google and show you how expensive call options will be if you are buying a call on Google just prior to earnings, right? Now, if we looked at the option chain for Google, and if we looked at the percentage change of volatility on the left-hand corner here, you can see that for Google for tomorrow, right, the option chain for tomorrow has a 93% implied volatility. That is a massive amount, right? And that's just because the market is pricing in the volatility that's actually going to happen at earnings. And if you had to buy a Google call at the money for tomorrow, it would cost you roughly about $1,000, right? So it's a $10 actual option chain, and you multiply that by 100, which is $1,000 for the actual contract, right? Now, again, we're showing you this because it's a situation that I've actually seen a lot of newer option traders actually get themselves into. They go and they buy an option right before earnings, hoping that the stock is actually going to go to the moon, right? And even if it does, the option is so expensive, and the drop in implied volatility will basically eviscerate all of the profits that you're hoping to actually get from the trade, right? Now, in this video, we've covered, the 3 pitfalls that, beginner investors might actually fall into, specifically on earnings, right? Whether you're a beginner investor or whether you're a beginner, option trader. I did want to give you another heads up here with regards to a tool that we've actually built. It's called the Wealth Grid, and we've actually built in an earnings calendar. And if you actually use this tool, it will actually send you reminders for when earnings are actually coming up for the stock that you actually hold within your holdings, right? And as you can see, there's a ton of earnings that's actually happening over the next week. We can see that Google's actually happening this week, and a ton of other communication services businesses. So this tool will give you a heads up specifically when earnings are coming around for the favorite stock that you might actually want to dollar cost average in, or if you're an option trader, just kind of give you an alert of, hey, options are coming up for Google, implied volatility might actually be high. Or if you are actually an option trader that actually sells options, this would be a really good time to actually sell options because the volatility is really high and the price that you're going to get for selling an option is going to be high as well. So with that, we've come to the end of another educational video here at Mindshift Theory. And for more content like this, visit us at Mindshift Theory and join our Wealth Circle group, where there is a ton more of investing knowledge and finance knowledge that will help you build a dividend portfolio the right way and give you so many tips with regards to option trading. So with that, I will see you in our next video.